Well, I would say that there are still plenty of attractive opportunities on the value end of the market. If you look at financials, if you look at some energy, if you look at some materials, you would clearly see that these stocks are nowhere where the rest of the market is, and specifically where the Nasdaq or the growth stocks are. So there is definitely some upside on the value end of the market. And to a large extent, I would say that this is what we are watching now.
Investors, though, note growth stocks can continue to rally even if the real economy doesn't. And it's been well and truly pointed out this disconnect now between the stock market and what is playing out on the ground for Main Street. What's your sense of what happens from here if we do continue to get some very grim news, even with the reopening of economies? Where does that leave the value sector? We know some of the banks also fall into the category.
I would not say that there has been a disconnect between what is happening in the economy and the markets. There is a disconnect if you look at the earnings for this year, that's for sure. But let's not forget that the earnings of this year is only 5% of the valuation of a stock into a perpetuity. So, if we contextualize this and we say we are not going to have some sort of meltdown and financial crisis like we saw 2008 and 2009, you'd say, well, we've got a recession, okay, let's calculate the impact of the earnings, massive, okay, but then if you're going to be having a V-shaped rebound, and given the amount of liquidity and fiscal stimulus that you're seeing, there is a good chance that, we may have that sometimes in 2021. That is only 5% of the valuation, and that is a very important point if you are a long-term investor.
Francesco, really good to hear from you this morning, my friend. Let me talk to you about CROCI bubble analysis. I was loving your charts that you sent over, talking about 35% of companies currently in bubble territory. What does that mean for our viewers? Is 35% a bad figure historically? Should we avoid those companies? Does it mean something for the rest of the market that's not in bubble territory? Just explain for us.
Well, clearly, if you look at the number of companies you have now, you have to look at how many companies have been in bubble historically, because there is always a part of the market that is expensive. And if you look at that chart from an historical perspective, you see that we are nowhere at the peak. We are not nowhere at the bottom as we were in 2008 and 2009. So markets are expensive. Yes, it is true to say that it is expensive, and but within historical range, and that is the important component. But what is also important is that we find many attractive value opportunities in the market, and this is what we think that investors should be focusing on.